A specific script has been handed down through generations, preached by parents and reinforced by the real estate industry. It claims that renting is equivalent to throwing money away, and that buying a house is the most reliable investment a person can make. We internalize this doctrine until it becomes part of our identity. The fear of failing to reach this milestone drives young adults to stretch their debt-to-income ratios to the breaking point just to sign a deed. This blind faith in homeownership can trap an entire generation in a cycle of illiquidity. In many markets, the house you live in acts as a financial anchor rather than a vehicle for growth. For the modern worker, a primary residence functions as a massive, leverage-fueled consumption purchase. We are often told that every mortgage payment builds personal equity. In the early years of a loan, however, the vast majority of that monthly cost disappears into interest and fees without touching the principal balance. Treating a home as a primary investment frequently results in a house-rich, cash-poor reality. It ties up the majority of a person's net worth in a single, immobile physical structure. To evaluate housing fairly, we have to look at the unrecoverable costs, the silent wealth killers that never return to your pocket. These are the expenses of ownership that mirror the lost money of rent. Of a $3,000 mortgage, only a $400 sliver builds equity. The rest is vaporized by bank interest. Costs stack further. Property taxes act as perpetual rent, while maintenance, insurance, and fees pile on. This total sunk cost easily rivals high rent. Instead of paying a landlord, the homeowner pays a syndicate comprised of the bank, the local municipality, and the hardware store. And that money is just as gone. This equation shows the price-to-rent ratio, the housing market's equivalent to a stock's P/E ratio. By dividing the price of a home by the annual cost to rent a similar property, you can see if the local market is overvalued. In many major cities today, like Toronto and San Francisco, the price-to-rent ratio in markets like New York and Sydney are pushing 25, 30, or even higher. When the ratio is this high, the cost of financing the purchase price far exceeds the cost of renting the same space. High-ratio renters let the landlord take on the risk of market crashes and broken foundations while they live in the asset at a mathematical discount. Then there is the dead equity in a down payment. Locking $100,000 into a house means that cash can no longer produce income, be rebalanced, or be used for emergencies. Nobel laureate Robert Shiller demonstrated that over the last century, real home prices have barely outpaced inflation. The massive gains many people cite are often specific to small bubble markets or specific decades. Contrast that with the stock market. That same $100,000 down payment, if invested in the S&P 500, has historically doubled roughly every 7 years. Prioritizing diverse global markets over a single local property allows for greater liquidity and a higher expected rate of return over the long term. The strongest argument for buying is the fixed-rate mortgage, which acts as a hedge against rising rent. However, while the mortgage principal is fixed, the taxes, insurance premiums, and maintenance labor all rise with inflation. You are not immune to rising costs. You are just exposed to them through different channels. Mathematically, a stock portfolio growing at 7 to 10% a year will likely outpace a standard 3% annual increase in rent. Using appreciating liquid assets to cover your housing costs provides more flexibility than trying to freeze the cost of a physical building. In a volatile economy, the ability to relocate for a higher salary is a significant financial asset. A renter can move for a better opportunity in 30 days with minimal friction. A homeowner must pay agent fees, staging costs, and closing fees, transaction costs that can reach 10% of the asset's value. Selling a home to move for a job can wipe out years of equity in a single transaction. Preserving geographic mobility holds a premium value that is rarely accounted for on a standard real estate spreadsheet. Ultimately, a house is a place to live. It is a personal consumption choice, not a mandatory prerequisite for building wealth or securing a retirement. Rather than following cultural pressure, you can run the numbers for your specific market. If the ratio suggests renting, you can do so with the knowledge that your capital is working elsewhere. Separating your housing consumption from your pursuit of wealth allows you to prioritize assets that produce income. By investing the difference, you can build a portfolio of diverse assets while the landlord worries about the roof.